So here we are at the episode 12. So if episode 11 is the last episode on interpolation, this episode is the last for the effective interest rate. And we will talk about how to get the effective rate for debts or receivables with 1 year maturity term in this video. So let's start that after this short intro. So again, this video is made for the purpose of answering the question, how to get the effective rate of debts and receivables with 1 year maturity. Okay? Now, to make this a little bit faster, let's have the previous sample problem. However, let's change the maturity term to 1 year. Okay? So, how to get the effective rate? Guys, I will tell you in advance. We don't need to do the interpolation and the trial and error. We just need two things. We just need to have the net interest to be paid over the proceeds. That's the only two amounts that you need. But it's not that simple. We need to elaborate each of these. So let's start with the numerator. So the numerator is the net interest to be paid. Well, if you break this down, this numerator is actually interest to be paid minus the interest income. And if you still want to break this down, interest to be paid is actually nominal interest rate or the agreed interest rate times the principal to be paid. And in this case, we have 7% times 4,250,000. And you already know that because of the past episodes, right? So let's go to the interest income. In your mind, you might be thinking, why is there an interest income here? So let's answer that. It's because sometimes the banks and other creditors and other financial institutions would demand you to open a savings account before they grant you the loan. And that account is restricted from withdrawal unless you have already paid in full. So that is what do we call a compensating balance. And it is called as such because sometimes if the debtor defaults or delays on a scheduled payment, for example, paying the scheduled interest. So if the debtor delays, they are going to charge or deduct automatically from that savings account of yours. Okay? Of course, that savings account that you opened will earn interest income, right? So that's the interest income here. And if you wanted to get this interest income, we just have to break this down. We have compensating balance times the interest income rate. Okay? So that's how you break this numerator down, the net interest to be paid. So the denominator will be next after this. So, before we break down the denominator, let's add something to the sample problem to make it more challenging and more complete. Okay? So, as if, aside from these details right here, the bank also required you to open a savings account of 200,000. But since you already have 150,000 savings in the bank before you applied for a loan, you only added 50,000 to comply with the compensating balance requirement. And in addition, the said 50,000 mentioned was already part of the deductions right here. And lastly, the savings normally earns 3% per annum in that said bank. So that's the whole sample problem that we need to solve later in the next slide. Okay? For now, let's break the denominator down or these proceeds. So proceeds is actually the ultimate or ultimately the money that the borrower received when the loan was granted. And if we break this down, this is just principal minus deductions. And what are these deductions? Again, it can be service charges. It can also be the amount of interest paid in advance. And it can also be the compensating balance required for the loan to be approved, or anything that will reduce the amount of proceeds that you are going to receive if you are the debtor. So that's it for the breakdown of the denominator. Now, it's time to apply what we've learned by solving this sample problem. So, this is the previous slide containing the problem that we are to solve. Okay? So, we are gonna use this slide as a guide in making our solution. So, the question here is, what is the effective rate? Okay, so as I have told you earlier, you only need to find the net interest over the proceeds. So, let's start with the net interest. So, interest to be paid minus interest income, right? So, interest to be paid is principal times nominal rate. So, 4,250,000 times 7% equals 297,500. So, that's the interest to be paid. Okay? So, now let's go to the interest income, which is the compensating balance times the interest income rate. So, the compensating balance that we are going to use is only 50,000, not the whole 200,000. The 150,000 should not be included in our solution because that savings balance was already existing before this loan transaction. And aside from that, the 150,000 was not deducted from the proceeds that you as the debtor received. Okay? So again, let's use only the 50,000. And then 50,000, let's multiply it with the 3% annual interest income rate. And that will be equal to 1,500. So, the numerator is 297,500 minus 1,500, and it's equal to 296,000. Okay? So, let's go to the denominator. So, we have 4 million immediately because it was already given here in the problem that the proceeds is 4 million. But in some problems, proceeds is not directly given. So you need to do this. Principal minus the deductions. Like again, service charges, advance payments of interest, or the required compensating balance, and other deductions. And sometimes, guys, these deductions, you need to remember this. These are sometimes called flotation costs. So here's the spelling, flotation costs. And that's it for the denominator. So, the real interest rate that you are paying if you are the debtor in this problem is 296,000 over 4 million. And that's 0.074 or 7.4%. So, that's it for this video lecture. In the next episode, let's talk about multiple unequal payments and other twists in the present value topic. And hopefully, the next episode is the last for the present value series. So, if you learned, please click like, subscribe, and hit the notification bell and select all to be updated on my next videos. So thank you for watching and see you on the next one.